1. Origins at Bretton Woods 1944. The story of the World Bank and the International Monetary Fund begins in the shadow of World War II. The global economy had been shattered by years of destruction, trade barriers, and financial collapse. In 1944, delegates from 44 nations gathered in Bretton Woods, New Hampshire, with one goal: to prevent another economic catastrophe like the Great Depression and to rebuild war-torn Europe. Out of that historic meeting, two powerful institutions were born: the International Monetary Fund, created to oversee global monetary stability, and the World Bank, initially focused on reconstruction and development. At first, their missions sounded noble: help countries stabilize their economies, finance rebuilding, and promote global cooperation. Few could have predicted that, decades later, these same organizations would be accused of fueling inequality, enforcing harsh conditions, and acting as gatekeepers of a so-called New World Order. Their origin story is rooted in hope, but their legacy has been deeply controversial. What started as a rescue mission in 1944 would soon become one of the most powerful and controversial financial empires in the modern world. 2. Different roles, though they are often mentioned together, the IMF and World Bank are not the same. The International Monetary Fund is like the world's financial doctor, stepping in when countries face balance of payment crises, currency instability, or runaway inflation. Its main tool is short-term loans aimed at stabilizing a nation's economy. On the other hand, the World Bank is more like a development agency, lending money for long-term projects like building roads, schools, power plants, or clean water systems. Together, they present themselves as twin pillars of global stability, each with a distinct mission but overlapping influence. Yet, in practice, their roles often blur. A country in crisis may borrow from both institutions simultaneously, finding itself tied to strict programs and policies dictated from Washington, where both institutions are headquartered. These roles may sound supportive on paper, but in reality, they can give the institutions immense control over how nations run their economies and societies. Two institutions, two missions, but one enormous influence over the fate of nations. 3. Loan conditionality. Here's where the controversy begins. The IMF and World Bank don't just hand out money with no strings attached. Their loans come with detailed conditionalities, economic policies that borrowing nations must implement in exchange for financial support. These conditions can include cutting government spending, reducing subsidies on food or fuel, privatizing state-owned companies, and opening markets to foreign investors. While the logic is that these reforms create stability and growth, the reality is often harsh. In many cases, these conditions lead to rising unemployment, reduced social services, and higher costs of living for ordinary citizens. For countries already struggling, the medicine can feel worse than the disease. Critics argue that these conditionalities strip nations of sovereignty, forcing them to reshape their economies in line with Western capitalist models, regardless of local needs or circumstances. This is where the idea of the IMF and World Bank as tools of global control begins to take root. When money comes with strings attached, who's really in control, the borrower or the lender pulling the strings? Or structural adjustment programs. The 1980s marked a new era for the IMF and World Bank, with the rise of structural adjustment programs, or SAPs. These programs became infamous across Africa, Latin America, and parts of Asia. Countries burdened by debt were told they could receive financial support only if they agreed to implement sweeping reforms, cut public spending, deregulate industries, liberalize trade, and privatize public assets. The results were mixed, but in many places, the consequences were devastating. Schools and hospitals suffered from budget cuts, farmers faced rising costs as subsidies disappeared, and entire industries collapsed under the weight of sudden foreign competition. While the stated goal was to encourage efficiency and growth, the human cost was staggering. Many nations saw poverty deepen instead of decline. Over time, SAPs became symbolic of a system where financial aid was tied not to relief, but to reshaping entire societies along Western economic lines. For many nations, structural adjustment felt less like a helping hand and more like economic handcuffs. 5. Power imbalance. One of the biggest criticisms of the IMF and World Bank is how they are governed. Voting power in both institutions is not equal among members. It's based on financial contributions. This means wealthy countries, especially the United States, hold disproportionate influence over major decisions. For example, the US alone holds veto power in the IMF, allowing it to block any major reforms it doesn't like. Smaller and poorer countries, ironically the very ones most affected by IMF and World Bank policies, have little say in how the institutions are run. Critics see 6. Criticism across decades. The IMF and World Bank have faced waves of criticism from activists, scholars, and even former insiders. Detractors argue that their programs often hurt the very people they claim to help. Austerity measures cut public services just when people need them most. Privatization hands essential services like water and electricity to corporations, making them unaffordable for the poor. Trade liberalization floods local markets with cheap imports, wiping out domestic industries. Critics also accuse the institutions of creating dependency countries borrowed to survive, then borrow again to repay previous loans, entering a cycle of debt that is almost impossible to escape. This has fueled accusations that the IMF and World Bank are not neutral helpers, but instruments of economic imperialism designed to keep poorer nations under control, while opening markets for global corporations. For many critics, the IMF and World Bank don't fight poverty, they manufacture it in new forms. 7. Supporters' view. But the picture isn't entirely one-sided. Supporters of the IMF and World Bank point to the many successes of their programs. The World Bank has helped finance millions of miles of roads, brought electricity to rural villages, and funded education programs in places that once had none. The IMF has stepped in during financial crises to prevent total economic collapse, such as in South Korea during the Asian financial crisis and more recently during the COVID-19 pandemic. Supporters argue that while conditionalities can be painful, they often push countries to make difficult reforms that lead to long-term stability. Without these institutions, some claim, many nations would face even worse hardships, falling into hyperinflation, chaos, or isolation from global markets. From this perspective, the IMF and World Bank are imperfect but necessary tools in an interconnected world. Are they saviors in disguise, or simply doctors prescribing bitter medicine to a world in economic pain? 8. Geopolitical influence. Beyond economics, the IMF and World Bank are often seen as instruments of geopolitical influence. Because the US and other wealthy nations hold the most power, loans and policies can sometimes align suspiciously well with Western foreign policy interests. Countries that are strategic allies may receive favorable treatment, while those that oppose Western interests often find conditions harsher or loans withheld. This fuels the perception that these institutions are not just about development and stability, but about maintaining a global order where the West stays on top. In this sense, the IMF and World Bank become more than financial tools, they are levers of diplomacy and control, shaping not only economies but also politics and alliances around the world. When economics and politics mix, the question becomes, are these institutions helping nations or helping empires? 9. Reforms and evolution. Over time, both institutions have attempted reforms to address criticism. The World Bank shifted some of its focus toward poverty reduction, education, and environmental sustainability. The IMF began talking about social protections and inequality alongside fiscal stability. In recent years, climate change has become a new frontier, with both institutions funding green projects and sustainable initiatives. Yet these shifts have also been criticized as mission creep, with the institutions stretching far beyond their original mandates. While they've modernized their language, critics argue that the underlying power imbalance and conditional lending remain unchanged. Reforms may soften the image of the IMF and World Bank, but many believe they still operate with the same fundamental purpose: to keep the global economic system functioning in a way that favors the powerful. New missions, new buzzwords, but is it real reform, or just old power wearing a fresh mask? 10. The New World Order narrative. All of this controversy has fed into a bigger, more dramatic narrative, that the World Bank and IMF are tools of a new world order. According to this perspective, they are not simply financial institutions, but instruments of global elites, who seek to reshape the world in their image. For critics, the conditionalities, structural adjustments, and geopolitical favoritism are not random, but part of a deliberate design to weaken national sovereignty and enforce a single global economic model, while mainstream analysts dismiss this as conspiracy theory.